What is going on YouTube? Welcome back to another video. So recently I reached out to someone in my network who works in leverage finance as a credit risk manager. And I asked them to tell me two of their favorite things about working in their role and two of their least favorite things about working as a credit risk manager. So what we're going to do today in this new series where I talk about different roles and, reach out to people who actually work in the industry and can share some of their pros and cons about their roles. Today, we're going to talk about the role of a credit risk manager, what they do, what you can expect if you're interested in such a role. And then if you stick around towards the end of the video, I'll share with you what they said were their two most favorite things about the role and two least favorite things about working in such a position. So with that, so also worth mentioning, the person is a VP at a global bank. And with that, let's get straight into the video. Quick note, if you're interested in a quick guide or 1 or 2 page, I haven't finished it yet, on leverage finance and credit risk management, it's in the link in the video description down below, the first link, and you can get it, download it for free. It's something I've created just in case it's useful for you to print out, put it on your wall, whatever it might be, in case you're going for an interview or you just want an overview of the role. So that's in the video description down below. All right, so what is leverage finance to start off with? So leverage finance focuses on two things. It focuses on providing debt financing rather than equity financing, so debt financing to companies, and it focuses on offering financing to companies that have high levels of debt. So offering financing to companies who aren't in the most stable or financially sound position. As a result, these types of companies are typically willing to take on more risk in order to achieve a higher reward. So one, leverage finance focuses on debt financing. In order to get leverage, you increase debt, you lever up. So you take on more debt, you borrow more money, and then you can, use that greater sum of money to invest or offer financing, and that maximizes or enlarges the potential returns. And two, you're focusing on companies that have high levels of debt, so they are typically willing to take on more risk and have a higher risk profile compared to companies who don't have as much debt on their balance sheets. Now, the financing in leverage finance offered to companies can be used for mergers, can be used for acquisitions, can be used for leverage buyouts, corporate restructuring, so on and so forth. But what exactly does a credit risk manager specifically do in this role? So let's go through them. All right, first things first, they do a lot of credit analysis. So what is credit analysis? Credit analysis is when they are doing research into the credit worthiness of the potential borrower. So let's say you are the credit risk manager that I reached out to, and they've got a client that's come to them to borrow some money, right? So they're not just going to give them the money. Actually, a better example, let's say I go to the bank and I want to take out money for a mortgage. They're going to do background checks. They're going to check my credit worthiness. They're going to see if I can pay them back the money that I'm going to borrow plus interest, right? And so the credit risk manager is responsible for doing that research, that background credit worthiness research on the client, so that they know if their bank gives them money, they'll be able to pay it back plus the interest and all the other terms that they agree to. So they do a lot of background checks. On top of this, as part of credit analysis, they are going to have to look into the inner workings of the company that wants to borrow money. So what does that mean? They're going to need to look at the financial statements, cash flow projections, industry trends. Is now a good time for this type of company in a particular industry to borrow money, or is it a bad time? Is the industry going for a negative trend, or is it going for a positive trend? What do the forecasts for revenue look like 5-10 years down the line for this type of company? All these types of things they need to do in order to analyze the creditworthiness of the client that wants to borrow money. And the reason for that essentially is you don't want to give out your bank's money to a client who's not going to pay you back. So once the credit analysis is done, they're going to do a risk assessment. So what this focuses on is industry dynamics, market conditions, and most importantly, the specific terms of the financing agreement. So two parties are coming together, right? And there's going to be lots of terms. If we give you this much money, you're going to pay back this much plus this, blah, 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 blah. All these specific terms. So the specific terms are very important because the bank needs to make sure they are getting a good deal. Someone's come to them for money, they need to make money or make fees from it, right? And so the specific terms of the agreement is very important, and that falls into the risk assessment. You don't want to give terms that benefit the borrower so much so that it doesn't benefit the lender. And so the risk assessment will identify if the agreements that the client has come to you with are worth pursuing or not. Next, we've got due diligence. So due diligence just means basically tons of background research. So if I am applying to a job at an investment bank and I get the offer, they're going to hire another company to do a background search on me. They search if I've got a criminal record, just anything and everything on my background. So similarly, the credit risk manager is going to do tons of due diligence on a company that wants to borrow money. Why are they going to do that? Let's say a client comes to you to borrow money, you give them money, and then they go and spend that money 2 weeks down the road or 2 months down the road, you find out that they are funding terrorism, or they're funding something that isn't ethically right or that you don't agree with. And so it puts your company, your bank at risk. The last thing you want to do is fund a borrower and end up on the front page of the Financial Times for the wrong reason. And that's why it's very important to carry out due diligence so you know who you're lending your money to. You don't want to just lend your money to anyone and everyone. It's important that you pick your clients wisely, and that's where due diligence comes in. Over time, let's say I'm a credit risk manager, I'm going to work on lots of different deals and transactions and financing offerings, right? And so over time I build up a portfolio of these deals that I've worked on. Now, it's not like I do a financing transaction and it ends just there, because these clients are borrowing money over 5, 10, 15, 20 plus years. They are going to stick around for a long time. And so over time, I, or the credit risk manager, would go back into, these different deals that they've done and just see how they're getting on. Is the borrower keeping up with their payments? Has anything changed in the market or with respect to the borrower's financial position that is going to impact the bank or our bank from getting the money that we're owed? The reason to do the portfolio management is just to ensure that you're mitigating any risk. So you're keeping an eye on your previous deals, so it's never too late and then you look back and something's gone, there's like a madness going on and you can't fix it. So you don't lose out on money and you get what you're owed, and you just got to manage the portfolio so that you are not at risk of losing out for the bank, basically. If an issue does arise, for example, you would address it. There might be penalties in the contract. This goes back to the specific terms of each deal. But yeah, the purpose of assessing or monitoring borrower performance is so that nothing goes belly up and just ruins a potential deal. Credit risk managers also have to collaborate with other employees in the organization. This is very important. They work closely with relationship managers, salespeople. They work closely with people in compliance, legal, all these contracts that are getting drawn up. They need to work closely with them, the legal team, so on and so forth. So in your role, you're going to be working with lots of different people. A lot of different people are going to be coming to you because you're the expert on all things credit risk, right? So anytime there's a borrower, anytime anyone needs advice on the credit markets or credit risk specifically, they'll come to you because you're the expert and you can give your expert advice, knowledge to different teams, different individuals across seniorities. So that's another component of the role. Last but not least, compliance and regulation. So the industry is always going to be changing. Borrowing and lending is going to have lots of rules and regulations, which are always adapting, changing, progressing, regressing. And so it's important for you as a credit risk manager to kind of stay up to date with what's going on in the markets, keep up to date with the latest regulations. So it requires a lot of reading. So you're up to date on the latest legislations and rules and regulations so that when you are working on your next transaction or deal, you are up to date with what's most relevant and most recent, so you don't fall behind, basically. So there's a lot of staying up to date that's needed. Sorry if that was long-winded, but those are some of the key components of what a credit risk manager in leverage finance does. Now let's go on to the 2 favorite things about the role that I asked the person who works in credit risk management as a VP at a big bank, and their 2 least favorite things. All right, so I've got them here. 2 favorite things. All right, the first one is intellectual curiosity. You really get under the bonnet to understand how a business works, and your job is to identify the risks and assess the likelihood and how they may result in the business defaulting on their obligations. The variety in businesses is vast, so you get to work with lots of different businesses of different sizes, different industries, different regions. One day you might work with a big tech company, the next day you might work with a toiletries company, for example. So it really does vary. And they are all unique. You will always be learning something new. So if you like to be challenged intellectually and constantly learning something new, that's one of the pros. The second favorite thing they mentioned is purpose, accountability, and being empowered. You're responsible for making lending decisions which must be balanced between risk and gains, with implications for your shareholders, the businesses you lend to, their employees, customers, and beyond. This is a good point. So, if you're the key person making credit risk or credit lending decisions, you hold the key to offer money to these organizations that need it. As a result, that organization can use that money to grow, to release new products, to keep its shareholders happy. It grows as a result of your financing, offers new products. It means its employees are happy, its customers are happy. And so because of your one lending decision, you have a lot of impact. So you do get a lot of responsibility and power being in such a position. So that's the second benefit they've mentioned. All right, 2 of their least favorite parts of the role. First is the intensity. It can be very intense and demanding as transactions are pressured by time and competition, with a significant amount of information to absorb and decisions to be made. So this is basically alluding to the fact that a client might come to you with a request. We want to borrow X $100,000 or X million pounds, whatever it is, and they will specify their terms, right? So they've come to you. You might be working on, you know, all right, let's assess this. Is it worth us working on this? But keep in mind that client has also probably gone to 2 or 3 or 4 other different banks with the same proposal. And so obviously each bank, including yourself, wants to win this business because you get a fee, you get interest payments, whatever it is, you make money from it. And so a lot of work needs to be done, and it needs to be done in a timely fashion. So there's a lot of pressure, tons of information you need to gather, analyze, research, due diligence, all of that, and come up with the best offer, do it within the deadline, and then hopefully win that business. And you're competing with other top banks, so it's very competitive. And then the last point they mentioned, the least favorite thing, another least favorite thing is the ambiguity and uncertainty. So 0 risk does not exist, and we can't crystal ball gaze for all potential unexpected risks. Example is COVID. There is also no one clear right or wrong answer. You can only make decisions based on the information you have at that point in time. You will have to deal with the sense that your assessment might be flawed. In this type of role, there's no perfect solution. There's no right or wrong answer. There's going to be tens of hundreds of different solutions that might work for the client. And even if you think you've got the best solution, you could put it forward and then COVID happens, or, you know, there's a recession, or the market cycle changes. And so all these external factors can just flip the script. And so the best you can do is carry out your credit analysis, risk assessment, due diligence, all these things to the best of your ability. Stay up to date with what's going on from a regulatory perspective, and then offer your best proposal to the client. And then, you know, if something does happen like COVID, then you've got to be on the ball and, you know, act accordingly. But yeah, I guess that's part of the excitement of such a role. You're not kind of going into the role and doing the same thing every single day. Each client is different. It brings its own challenges. I'm talking like I've done the role. I haven't done the role, but, you know, hopefully it's clear and you're understanding what I'm talking about. Anyway, that was the overview and 2 most favorite and 2 least favorite things of a credit risk manager in leverage finance working at a big bank who's a VP. Next week, or the next video in this series, is going to be on equity research. So I've reached out to a VP in equity research at a bank, and this is where you can get involved as well. Let me know in the comments down below which role, which seniority, which bank, which person, which division, whatever it is, more specifically which role you want me to cover in a future video, and I'll add it to the list in the series. Because I realized, look, I've got lots of people in my network in the industry, and I think it's useful to do this type of video where I, you know, get information from them and put it out in a video. Most times they want to be anonymous because compliance at banks don't want people to talk on YouTube, or for whatever reason. Some of them are more than happy not to be anonymous. And so I might do interviews, but we'll see about that. Either way, let me know in the comments what roles you want me to do next, and I will see you in the next video. Thanks for making it to the end. Give the video a thumbs up. With that, peace.